Well, another bloodbath on Wall Street once again. In today's video, we're going to be talking about how the bears have this current control and what we need to see in order for the bulls to step back up. I got some interesting charts to show you today. So today's episode is going to be a little bit different than usual. If you're new here, well, welcome to the show. This is the Stock Market Brief Show. My name is Michael Silva. I spelled my last name incorrectly, and I'm just noticing that right now. We use technical analysis, intermarket analysis to get a good idea as to where the market might be headed next. If you haven't done so already, make sure to hit that thumbs up button. It's greatly appreciated. That's how you sponsor the video, and make sure to hit that sub button as well. I'm almost at 100,000 subs. Holy moly. All right, let's get into today's episode. All right, everybody, welcome back. So yes, well, like I said, it's been a bloodbath on Wall Street these last few trading days. Today's week, shorter than usual. We have utilities and healthcare and real estate leading the pack. These are more defensive sectors, but they were still down on the day. The ones that took it on the chin were energy and consumer discretionary. Very interesting day with energy because energy was actually one of the leaders out of the gate. And it really just a big gap up, but it just headed straight down. Now, there was a lot of news headlines, right? That's not going to stop. Everyone's heard. There's a lot of Russia, Ukraine, geopolitical risks. Then we have the Fed risks too as well. So who knows how this is all going to play out, but we got some interesting stuff to go over today. So let's just keep moving on here. This is ratios that I like to look at, and it's ratios of more safety type trades. So when these lines go up, that means there's a lot of safety at play, like a rotation into safety. What do I mean? Well, first and foremost, it's a relative strength line, meaning how is a specific asset performing relative to the S&P 500? So, for example, we have gold right here. We have utilities, consumer staples. We have TLT. We have defensive ETF. And we have healthcare. And as you can see, just across the board on all of these, they're above the 50-period moving average. The lines are pointing up. And guess what? If you just take a look at this date right here, 2022, and you go all the way down, what you'll see is all of these are up on the start of the year. So, I'm not going to go through all of them, but you can see it opened. Now it's here, opened, and now it's here, open here. I guess I'll go through all of them. Bam, and then bam. So gold is one of the more stronger ones performing as of now. So just so you know, the safety trade really is still on right now. And a lot of people are calling for, the melt up, and we're risk on right now, but the price action just doesn't justify that yet at this current point in time. But I'll show you what we need to look for in order to see a risk-on environment. Now, I posted this on Twitter. If you don't follow me there, you can follow me there. The link's in the description. And I'm looking at a quarterly chart. That means that every single candle on this chart represents 1 quarter. 1 quarter is 3 months of data. So this is a long-term chart. It's 25 years, okay? And each candle represents, like I said, 3 months or 1 quarter. And something very interesting here that I want to point out. So I highlighted blue boxes and red boxes. The blue boxes represent the time that the quarterly candle closed beneath the 5-period EMA. Now this is interesting because most of the time, so 1, 2, 3, 4, 5, 6 out of 8 times, so 6 out of 8 times that the quarterly candle closed beneath the 5 EMA, the very next quarter, the candle actually closed in the green and got back above that quarterly 5 EMA, that purple line. So right here, you can see closed basically right on it to underneath it. Next quarter, saved. Right here, next quarter, saved. Next quarter, saved, and saved. Now, this is interesting because it hasn't happened many times when you get a quarterly candle closed below that 5 EMA. However, these 2 times, notice the difference here. It had 2 quarters that closed beneath the 5 EMA, and that right there led to the dot-com bust and the financial crisis. Why is this important? Well, I'm showing you this because we're right now fluttering right around that quarterly 5 EMA. We've already had a very aggressive quarter to the downside, and we still have another month, a little bit more than a month, left to see where this can close. But I'm getting it on your radar now because if we do close below the 5 EMA, and in the following quarter we close beneath the 5 EMA, that could spell out some more downside ahead. Now, there's also a possibility that we close above the 5 EMA, but next quarter we close below it. So I'll be talking about this chart, at month's end and or quarter ends in the near future. Now, one thing that I also want to point out is that all these blue boxes, even including the red boxes, every time we had a quarterly candle close below that 5 EMA, guess what happened? The Fed stepped in and they did some sort of aggressive policy in order to alleviate that downwards price action in the markets. So for example, I'm not going to go through all of them, but just to give you a couple, this right here was when a hedge fund blew up in 98. They actually wrote a book about that called When Genius Fails. Here, the dot-com bust, I think that was Alan Greenspan around that time, but we have QE 1, 2, 3, we have Operation Twist. We had a period in time where the Chinese stock market was collapsing. We had the repo whole fiasco in 2018 leading into 2019, and then we have QE Unlimited 2 as well. So, if we get a quarterly close, we're walking, and another reason why I'm showing you this is because we're coming into an environment where rates are already smashed down. Okay, we have the yield curve getting closer and closer to inversion of the 10s and 2s. Even today, I don't have that chart specifically, but it got closer to an inversion, so it flattened out even more. It's like, it's a pancake, and it's almost going to give us that trigger for a recession warning. But the reason why I'm showing you that and telling you this now is because we're at a period in time where the Fed is basically saying we're going to be lifting rates into a slowing growth, into slowing growth, and then two, there's really no sign of them with the Fed put at this particular point in time. So I don't know if that's going to change or what's going to take place in order for them to start backing off of that rhetoric. But as it stands right now, it looks like we're moving into a tightening cycle as well as a slowing growth cycle, which could definitely force more downwards price action in the S&P 500. And we're seeing that as far as volatility goes. I'm going on a little bit of a tangent there. Now, this is what we need to see in order for the bulls to get back in charge. The 5-period EMA on the weekly time frame, okay, that is that dashed blue line. Okay, the dashed blue line, it's pointing down. So what we need to see is the bulls to close above that. Okay, if the bulls can manage to close above that 5-period EMA, that gets them back at least in short-term control. And why do I say that? Is because, well, when we closed beneath it, right here, right? That was a warning sign. We've closed beneath it many times, but it typically gets recovered right away. And as you can see, we closed beneath it again, beneath it, beneath it, beneath it, beneath it, beneath it, beneath it. So we had 1, 2, 3, 4, 5, 6, 7 weeks now trading beneath it. Now this week's not over, right? But we'll see what happens. Now, if they can get control of it going into the end of this week, that would actually look pretty positive overall, and that would be a very strong-looking candle. That would be known as a bullish engulfing candle, where the body of this candle engulfs the entire thing, and that could project us up further. So that is what we need to pay attention to. Keep in mind, the PMO still facing down south, RSI still pointing down south too as well. So you're trying to catch a knife right here. And the same thing goes with the Qs. The Qs, coming into an area of support right around 335, right? Support, resistance, but we need to get back above that declining 5-period moving average, okay? Now, if we hop into some daily charts, let's look at the SPY. I'm showing you the risk range just to update you with it. We are not quite down there as of yet, so it still shows with this big risk range, right, plus or minus, there's a lot of room for a lot of volatility, and that makes sense given all of these geopolitical risks and any type of news that hits the tape. It can really stutter the market. Now, going into tomorrow, this is kind of this is what I think would happen, but this right here, this candle is a wide range candle, small body, kind of a little bit undecided. We did make a new low close on the year. Okay, so not the greatest looking thing. I'm thinking tomorrow, chances are we'll probably put in another lower high, and we'll probably have a matching low, if not a little bit higher. So that would mean that we'll probably just have like an inside trading day tomorrow, which means we might just have a lot of back and forth swings. Okay, so that's what I'm kind of looking at going into tomorrow. I will point out that on the BP chart, we do have that positive divergence, and there's still room. We had the positive divergence, play out, and we still have this pointing down, showing that there's more room for this to head lower, but it can also start turning around too as well. Now let's take a look at the Qs on the daily time frame. This candle right here, very indecisive, but there's a large range, right? Large high to low. So this right here, I just want to call out, you can see that we had a big range candle, decisive, and then all of a sudden this narrow body shows a slowing of momentum to the downside and indecision. So that tells me also potentially tomorrow, right? And by the way, we're hitting into an area of support. Chances are, in my opinion, I think we can put in a lower high and probably maybe trade around here to this previous low, but my guess would be somewhat of an inside trading candle going into tomorrow. Now, keep in mind, news can hit the tape and it could shake things up, but that is a wide range candle heading into tomorrow. I wouldn't be shocked for some sideways consolidation. Okay, so that is what I'm looking for heading into tomorrow. If we actually take a look at the BP chart for the BP NDX, still has room to go down lower, but as you can see, it is getting a little over. It could be very well getting overextended here very quickly, which could present itself as a bounce, okay? So having a bounce go up to here, we can't rule that off the table for both the Qs and the SPY. Now, this is where I want to show you something that kind of reminded me. I showed a chart in a previous video, I don't know when, but this does kind of remind me of 2018. What do I mean? Okay, so first and foremost, I'm looking at the S&P 500 here, the SPY. This is in 2018, okay? And I just want to run this by you guys just so you can see what volatility could do and what it looks like, okay? So if you don't remember this period in time, that's totally fine, but just take note, right? So first and foremost, you can see this big drop off, right? And by the way, 2018 does seem very similar to what we're going through right now. Saw this little bounce up and then we came down lower right here, okay? That right there was about a 12% drop. Did I put it on there? Yeah, okay, so 11.4% drop. All right, and then we rallied back up. All right, and then we came back down, we rallied back up, and then we started selling off, okay? Down to around almost a bear market, which was minus 19.8%. So what does the SPY look like in comparison to this? Well, let's take a look. Okay, let me go to the next chart. The SPY, we're down from this peak, right, to this low, we're down 12.4%. Pretty darn similar to 2018. And after that move, we saw that run up and then this sell off back to this previous low. Now, did we actually match that low in 2018? Let's go back to the chart. As you can see, we had this low, we bounced all the way up, we came back, and we actually put in a higher low right there, and then we started to rally once again. Okay, so what would that look like on the S&P 500? So for example, right, so we had around that same exact drop off. What happened was we put in this low, a higher low, and then from that point, we actually rallied back up to the previous high. So as we get some indicators that are starting to look a little overextended, imagine how people and investors and sentiment would feel if we got a big rally right back up to around 457, this zone up in here. All right, everyone would be very, very bullish, right? I would imagine so. And that right there could be considered, people are gonna start talking to double bottom. If we start crossing above that, we're going to all-time highs. That is the tune of what you would start hearing. Okay, so to see a bounce coming from this, it's very, very possible, but as we're putting in lower highs and lower lows and we're getting below that 200 period moving average, just take that and be mindful, right? It doesn't mean it's gonna repeat itself and be just like 2018, but I will say, it does look quite similar. Now, to note, right, if we just look at them side by side actually, 2018, 2022, right? So we came down, up, down, up, down, okay? We got the rally, boom, everyone felt really good. Keep in mind, we didn't get any confirmation close above here, and then all of a sudden we saw some real damage to a bear market. Now, almost a bear market, I guess, and quote unquote, almost 20% down from peak to trough. If that were to happen here, you got to understand, you got to be prepared for something like that, a big move, and then imagine if it cracked down through that to fall 20%. That'd be a very, very large move. And we cannot rule that off the table given this current market environment and the amount of volatility that's being packed in here now, okay? So I just want you to understand and kind of, see this visually because it's a very strong possibility. Like, this is a strong move to the downside. Strong moves, understand, in bear markets typically see the greatest rallies. So what we've been noticing as of recently, and we'll wrap this up here in the conclusion, right? So I'll just draw this out. But what we typically see in a bull market is areas of support, they hold, boom, and areas of resistance, they break. However, what we've been seeing is areas of resistance holding and levels of support are breaking. Okay, and then you can see like bam, and then it cracks, and then it goes boom, and then it cracks, and so forth. So that is what we've been seeing as of recently. And when we see these big rallies intraday, those are just clearly short covering rallies where we get this move down and then all of a sudden it just rallies. Everyone's like, yes, 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 no, we're good, we're good. And then all of a sudden it comes back down to break down. So it's a very difficult environment to trade in. It's a very difficult environment to swing trade in. So you need to be obviously very careful and manage your risk. That's all I got for you on this show. Hopefully I gave you guys some good insights into what 2018 looked like and what we need to see in order for the bulls to get back that control. Have a wonderful night.